Well, I think you said volatility had a chance of coming back, and you were right this week.
Well, you can't have the market go up 10% and not take a breather or a break. I mean, it's just very difficult to have that happen. So we saw a little bit of volatility this week, but it looked like it ended today.
Yeah, pretty big reversal at the end of the day.
So yeah, today is Thursday, April 7th.
Yeah, nice reversal at the end of the day. But like you said, when we come off these big runs, I think we accurately predicted the bottom. I think 3 weeks ago, when we were talking on Weekly Sense, we were looking at the bottom formation. Hopefully that's right. Obviously there's always a possibility of a retest. But when you see these massive runs like we saw in the last 2 weeks, it's not sustainable, I guess, is the industry term. So seeing this volatility is a little bit normal. Plus, we finally got to hear from the Fed, which we'll get into it a little bit in just a second. But I think you wanted to start out about bull bear indicator or bull bear sentiment. Why don't you take the lead on that? I'll throw up the chart.
Right. There was an RBC, Royal Bank of Canada survey in March, and what was unique about it was that it was the first time since 2019 that there were more bears than bulls. So
now, isn't that usually a contrarian indicator?
Usually it is, yeah. Sentiment indicators, which all of the ones that we watched got pretty negative, as negative as they had been since March and April of 2020 when the COVID crash happened.
Right.
But the retail sentiment indicators of individual investors are not probably as good or as powerful because they can change their minds a little bit more easily. They're probably swayed by information a little bit more, but surveys of professionals seem to be a little bit more meaningful. So that's why we paid attention to this one, and it was interesting. And the fact that you had bears outweighing bulls here, when people were asked about expected stock market performance over the next 6 to 12 months, it was a good contrary sentiment indicator that helps confirm our view and observation that the market probably bottomed in this correction.
Yeah.
In February and March and maybe for the year. We'll see, right?
Yeah, it's really interesting. Obviously, the Fed's going to really dictate the direction of the markets. I think it's, everybody's, at least the market participants are on that bandwagon, and the Fed's really leading it. They're the lead horse pulling that wagon. I think that they have the chance to, cause more volatility. Or, based off of what they're going to say, maybe kind of keep things on a little bit smoother of a path, depending on the course of action that they indicate. Now, I know we did hear from the Fed earlier this week. They did announce the amounts of what they're going to do as far as selling bonds that are on, or maybe not selling, but winding down the balance sheet that they've accumulated, that they've doubled since 2020. Which is one pretty remarkable. That's also led to kind of the growth that we've seen. That's also led to the over leverage that we've seen. That's led to the housing market going crazy. At least one of the particular inputs in those equations. And now they're actually in the position where they're going to start unwinding that balance sheet. And some experts were thinking maybe 70 billion a month, maybe 80 billion a month. But they came out at about just under 100 billion a month of unwinding their balance sheet. Now, did that surprise you at all, Carl?
Not really. I mean, they're going to have to do a significant amount to get the balance sheet back down in a reasonable amount of time. And I think they realize, like a lot of people do, that this business cycle is moving faster and probably not going to last as long.
Right. And we've said that for a while.
Yeah. So I think they want to try to get the balance sheet closer to where reasonably close to where it was before the pandemic, but it's clear that they're not going to be able to get there. I think that if they start out with their 90 billion a month rate of
95
tightening.
Can't leave the 5 billion out. 95, no small number.
Yeah, I mean, it's going to be about, a little over $1 trillion a year.
Right.
And at that rate, it's going to take, if they do it over the next couple of years, that's only going to be about get through about half as much of the quantitative easing.
Yeah, that's only about a
done over the
quarter
last
that's
couple
only about a
years.
quarter of their balance sheet. Isn't it like 9 trillion?
Right.
Yeah. So I mean, it'll help a little bit, give them a little bit of room on the next one. But the problems that we face as investment advisors is not so much that we can't see that this is going to happen, but more so of the timing on how to get there, and shift portfolios in a way that's meaningful ahead of the next recession. I think that's probably the most challenging job that we've got over the next 6 to 12 months. And what's interesting to me is you're already starting to see the ramifications of just the Fed talking about it. And I know they announced in the last Fed minutes that came out from March that they would have hiked rates 50 basis points in March if it wasn't for Ukraine, which is really interesting. It kind of gives you that tone that they are taking it a little bit more seriously. They were probably asleep behind the wheel last year when they were talking about transitory, when transitory was the word of the year. And now they're in a position where they're behind that they have to aggressively raise rates. And what are those ramifications? So one thing I did want to pull up, because we talked about mortgage rates last year, or last Weekly Sense, is a chart of the home builders. So if I can just show you this real quickly, Carl, I just want to pull this up. So this is KB Home, down 30% so far this year. Okay, you've got Lennar down 34. You've got DR Horton down 34. You've got Pulte down 28. And what people have to remember and realize is that the market doesn't wait, right? So as they started to see rates move, or even as the Fed started to announce rate movements, you started to see some of these home builders, and this could start to lead to other areas of the economy because housing is such a significant part of purchasing assets. So any thoughts on this? I know I kind of threw this in. We weren't expected to talk about it, but I just wanted to kind of bring that up because it's tied to interest rates.
Right. Well, that's one thing that people look at as a leading indicator. There are all these economic leading indicators out there, but some people say that one of the best ones is just look at how the cyclical industries are doing under the surface. And when you see that kind of internal deterioration starting, where there's a rotation into more defensive sectors, and big sell-offs in cyclical industries and sectors like home builders, for example, that's a leading indicator of maybe that everything is going to roll over.
Sure.
Maybe in the not too distant future, or maybe we're on the brink of it.
Yeah.
Now.
And it's not just the home builders, right? Obviously, a lot of things have gotten whacked this year. And a lot of the higher growth names have gotten cut in half or even worse. I mean, we were looking at some of the holdings of Spyglass down 60, down 70, down 90% from their highs. You look at a stock like a Rivian, which is supposed to be the future Tesla. It's gone from $180 a share to, I think, like 36 or 37. So you're starting to see the ramifications of the Fed potentially moving in a more aggressive fashion. And it's not just risk assets. So this next chart I wanted to show was the bond market. Right? Everybody's like, well, hey, we'll just go to bonds. Well, let's see how that's done so far this year, which makes it really, really interesting. So you can see here's a chart and year-to-date performances for the different segments of the bond market, where the top line is the short end, so 1 to 3 years. The middle line is the ag, so the Barclays Bond Aggregate Index. And then the orange line is the long-dated treasuries, so 20 plus years. And the bond aggregate index is down 7 and the long end is down 15 because they're drastically affected by interest rates. So in this environment, we were a large majority of the conservative portfolio had been held in cash for this very reason. Isn't that correct?
That's right.
Right.
Yeah. When the last time we had volatility and treasuries actually rallied significantly was in early December. And we trimmed that position back a lot then, and we've been slowly adding back to it because you don't really know when the right moment will be to be owning a lot of longer term treasuries, but it feels like we're getting close to that. We've done a lot of work on the debt level in the government and how interest expense constrains spending, and it's not just there, but in the economy overall. And so the next thing that we're thinking about and looking about is now what's going to be the effect of all this quantitative tightening. How many effective like rate hikes is that going to feel like for the economy? So, and the reason that's important is because we don't really think that the Fed will be able to do as many rate hikes as they want to do. That was the way it was in 2018. And what was unique about that was that, you got into a big correction and they had to do, the Powell pivot or the Dovish pivot and not raise rates anymore. And then surprise, in the summer of 2019, there was a cut.
Right.
And what was interesting about the final stage of that business cycle was that the yield curve inverted, not because they raised the federal funds rate on the short end, but because long rates fell.
Sure.
And so probably because we've done so much quantitative easing in the wake of COVID, that phenomenon will probably repeat itself, and maybe even to a greater degree now than before.
Yeah, and I've talked to you. I think there's a lot of similarities. The more and more we did research on how sticky inflation could be and what the Fed has to necessarily do to control inflation, they don't have that many options. They've got to basically aggressively raise rates, which will naturally contract the economy or slow it down some. And when they do that, it's going to put a lot of pressure on risk assets. So we have this one chart because as we think about repositioning and the overall strategy that we're developing on the growth side of the portfolio, we're looking at alternatives for some of the growthier names. And what this chart points out, because I think there's going to be a lot of similarities to what happened in the 1970s, this chart basically shows that the lower PE stocks, the ones that have basically performed poorly or not as well as the growth names over the last 10 years, are actually the areas that performed well in the 1970s in a higher inflationary, more aggressively positioned Federal Reserve, like in the 1970s, like potentially what we could see now. But instead of like in the 1970s, like what you and I just said, where it was a 10-year cycle, it could be a lot more compressed to 2 or 3 year cycle here, but you could possibly still see the same outcomes of low PE stocks continuously outperforming those high PE valuations.
Right. And that's what we've seen really the last 4 months or so.
Sure.
It's hard to find growth stocks that have actually done well in that period of time, but you can look around and look at all the the boring cheap value stocks, and a lot of them are actually up over that period of time.
Right.
But I'm not sure that is something that's a reflection on like the quality and the growth prospects of those companies, but more that they're a place to put money.
Yeah, probably
So
sentiment
it may just
issue.
be it may just be a strange trade that's going on.
Right. Well, I know Alger put out that chart of historically prior to tightening cycles, value stocks tend to outperform over the 6 to 7 month period going into a rate hike, the first rate hike. And then, 2 or 3 months after that, growth stocks tend to outperform. And that was, data backed. We'll see if that plays out. We do have 2, amazing news stories to close out today's Weekly Sense, right? So 2 of the world's richest people went on a buying spree this week, right?
Right. Warren Buffett buying an 11% stake in HP and Berkshire Hathaway.
Yeah.
And Elon Musk, 9% stake in Twitter. He wants to enforce free speech over there a little bit more.
Well, and it must be nice to be able to just wake up on a Monday morning and throw $3 billion around. Yeah, there you go. I mean, what he spent on the acquisition of those shares, he made about a third of it back in the appreciation of the stock on the day of the announcement. So it'll be interesting.
Well, I don't know how much of that he could capture if he was to turn around and sell, but
Yeah.
it seems like his desire is to go activist over on Twitter. You know,
Well,
he put out a
look,
tweet today that the next Twitter board meeting will be lit.
that's what he said today, right?
Right.
Yeah. Well, I think that he's probably the smartest man on the planet. It seems to me that everything he touches turns to gold. I'm not saying that that's the case of what's going to happen with Twitter, but I think that he has an ability to influence the people that are around him, including potentially people on the board. My one critique is going to be, how does the SEC look at this, right? He's already been publicly scrutinized by the SEC on what he does on Twitter and how he does it on Twitter. And now is he the largest shareholder? He is the largest single shareholder. So it's almost like a spit in the face to the SEC. So we'll see how they react to that. And then on to Buffett, just to kind of close this out. I did read something that the Wall Street Journal put out today. Maybe this HP investment is more like the IBM investment he made about 6 or 7 years ago that didn't really pan out. You were saying something about HP where it's like not really even growing. It is at 10 times, or at least it was at 10 times earnings. What could the feather in the hat be there?
I'm not sure. I mean, HP has struggled for a long time.
Right.
And that's because the printer business, I mean,
Right, you mentioned
it's like it used to be a great business because it kind of followed that razor blade business model strategy where, they sell you the printer for, a cheap price, give it away. And then they sell you expensive ink cartridges. But what happened was all these people got into making those ink cartridges at lower prices and took that business away from HP. That's why they've struggled for so long.
Well, I know they're buying about $4 billion of shares back a year, $4 billion worth of shares back a year. Maybe it's a play on that. But it is definitely interesting to see the two richest people in the world, go on a buying spree. And Buffett this year has actually made a number of acquisitions. Buffett, Berkshire, between Oxy Petroleum, between the insurance company that he acquired, as well as now an 11% stake in HP. It seems like he's on a buying spree. And we're saying that maybe we've only got 18 to 24 months left in the business cycle. It's interesting to me.
Yeah, I'd be more willing to bet on Elon Musk making a successful free speech splash over at Twitter than Berkshire Hathaway doing something heroic with HP.
Yeah. Well, that's our segment this week. And I haven't said this in a long time, but how does it go, Carl? If it don't make dollars, it don't make sense, right?
That's right.
All right. Thanks, everybody. Catch you next week.
Thank you.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.